CPI and PPI might rhyme, but they definitely don't always move in tandem. So what is it, Rick?
Well, they don't, but they usually do rhyme. In this instance, there's a lot of similarities. If we look at the headline number, expected up 0.3 on final demand month over month for January. Wholesale producer price index comes in up 0.4, a bit hotter than expected, equaling November of last year and several other spots. But to find a higher number, you're going to April of 24 when it was up 0.5%. If we look at ex-food and energy, up 0.3, somewhat as expected. Definitely a lot hotter than the 0 in the rearview mirror, and that headline was 0.2 in the rearview mirror, so sequentially higher. 0.3 to find a higher number, you're going back to September of last year. Take out food, energy, and trade, also up 0.3, hotter than expected, and definitely sequentially hotter. Revisions coming in. We'll get to those in a minute. If we look at now the year-over-year final demand, expected 3.3, comes in 3.5, 3.5. That would be the hottest rate going back to Feb of 23. If we look at ex-food and energy on the year-over-year perspective, expecting 3.3, it's up 3.6. That would be the warmest going back to February of 23 as well. And finally, ex-food, ex-energy, ex-trade. And we're looking at a 3.1 coming in, comes out at 3.4. That would be the warmest going back to, you guessed it, 23, but this case, March of 23. Now, let's look at these revisions because they're substantial. And remember, like yesterday, there's going to be annual revisions, so not just what I'm looking at, but going back years. Okay, the headline number at 0.4 now follows 0.5 instead of up 0.2. Ex-food and energy up 0.3 now follows up 4 instead of unchanged. Ex-food, energy, and trade up 0.3 instead of following up 1/10 follows up 0.4. So those revisions changed everything sequentially. Everything now seems lower. But listen, that really isn't going to change the dynamic. The market smells this one. Interest rates reverse after looking at the first couple of monthly numbers and before revisions. We're now up at 461 on a 10, which would be minus 2 basis points net change. We see that the pre-opening equities at first rallied a bit. Now they're back down, but the numbers aren't large. I see Dow futures, which were up 1, are now down 5, 3, 2, 1. So getting right back to about where they were. What's interesting here is even though yields are a bit lower now, 10-year and 30-year have closed higher in yield 5 consecutive sessions. So we want to see if we're going to break that pattern today. And don't forget, yesterday was a 10-year note auction, and despite the big concession and how much higher interest rates moved, the auction didn't go particularly well. It was basically an average auction. Today we have 25 billion 30-year bonds. It's going to be interesting to see how that turns out. I know we talked about a week ago and we spent time under 4.5 briefly in a 10-year, under 4 3/4 briefly in a 30-year. And what did I say, Joe? Don't look for these to hold out much longer. The technical picture was we weren't going to spend a lot of time below those points, and boy, the technicals worked. So we want to really, really pay a close eye on this auction to see if we drum up any extra demand now that we've skipped over that 4 3/4 mark in a 30-year bond. Back to you.
Yeah,
futures. Hold on. I'm sorry, Joe. Hold on. Initial jobless claims. I apologize.
Oh, yeah.
213,000. Yeah. 213, that follows the slightly revised 220,000. And the best way to look at this is we haven't been over 250,000 since the first week in October of last year. And on continuing claims, 1,850,000, backing away from our one read at 1.9 million. That was the second week in January. That was the highest since November of 21, and we've been moving backwards since. This equals where we were in the second week of January, this 1,850,000, and you would have to go back to the third week in December to find a smaller continuing claims number. Now we're done. Apologize, folks. Back to you.